Good afternoon or morning to everyone, and thank you for joining us today for our webinar, Make Sure Your Money Goes to Your Heirs and Not to Uncle Sam, How to Defer or Reduce Tax Estate, with our host, Wayne Zell. I'm Kat Parker, Marketing Director at Zell Law, and I will be your co-host today. There will be a few polls throughout the presentation, and your answers will be anonymous, so feel free to answer honestly. We will also have a Q&A and a brief survey at the end of the presentation. Please chat me if you want to receive CE credit for this hour and were unable to submit your CFP information through the Zoom webinar registration. And now I'd like to turn it over to Wayne Zell, the founder of Zell Law, an estate and business planning law firm with offices in Reston, Virginia and Savannah, Georgia, serving clients nationwide.
Thanks, Kat. Welcome everybody to our latest lunch and learn. I hope you all have lunch there. We're going to have to figure out a way to buy Grubhub coupons for everybody going forward so that we can inspire more attendance. But today's a good session because we're going to be talking about not only some advanced estate planning techniques, but we're also going to be talking about ways of not necessarily being forced to pay the estate tax when it's due. There's some very cool code sections that have been around for a long time. And without boring you to tears in terms of the technical details, we're going to try to focus you on your clients or your business ways of deferring the estate tax for as long as 15 years. So that's kind of cool. The advanced estate planning stuff that we're going to be talking about involves some estate planning techniques, and we will also talk about how to recapitalize a corporation or a limited liability company or partnership to shift value to the next generation and out of your estate before it's too late and before estate taxes become due and owing. Our key talking points today, we're going to do some review. Some of you have been part of my lunch and learns and breakfast briefings where we've talked about GRATs, Grantor Retained Annuity Trusts. We also will be talking about Dynasty Trusts today and Spousal Lifetime Access Trusts. These are ways of reducing the taxable estate for clients or for you if you've got a significant estate. We're going to show you how to combine a family holding company, also known as a family LLC, limited liability company, with a Dynasty Trust or a SLAT. And at the end, we're going to talk about irrevocable life insurance trusts. But the sixth point we're going to talk about is how to defer or pay the estate tax over time. So these are the advanced estate planning topics we're going to talk about. We're going to try to keep on schedule so that we leave enough time at the end to talk about the tax payment provisions.
Now, Wayne, we do have a quick poll.
All righty.
So I'm going to go ahead and launch that. How many of you have used the following estate planning techniques in your or your client's estate planning? GRATs, Dynasty Trust, SLATs, family LLCs, ILITs, and you can select more than one.
ILIT refers to the Irrevocable Life Insurance Trust. And a SLAT is a Spousal Lifetime Access Trust. And again, Grantor Retained Annuity Trusts are commonly referred to as GRATs.
All right. And here are the results.
Wow. A lot of people have used these techniques. Everybody on the call has used an ILIT. And I know there's more than 6 people who are participating, but maybe they don't want to participate in the poll. So that's okay. That's great. Oops. Let's make that smaller. There we go. All right. So first, we're going to talk about GRATs and the benefit of a GRAT. Again, to reacquaint you with it, if you're not familiar with it, point out some of the upsides and the downsides of them, how to do a GRAT, what's the proper way of doing it. And then we'll also talk about intentionally defective grantor trusts, which is an alternative to a GRAT. Okay. Let's try that again real quick. So the steps in setting up a GRAT involve making a gift of assets to a trust, number one. Number two, after the gift has been made, a gift tax return has to be filed with the Internal Revenue Service, even if no tax is due. And many times we use zeroed out GRATs, GRATs that don't require any gift tax or use of gift tax exemption. After the gift tax return is filed, we're going to start making annuity payments. These are made on the first anniversary and subsequent anniversary of the funding of the GRAT when you've put the assets in. And they have to be made, the annuity payments have to be made by law within 105 days of the anniversary date. And then lastly, whatever's left over in this GRAT at the end of the term either is going to be paid out to the beneficiaries directly or paid over to a trust for their benefit. What does the gift of assets look like? Well, the first thing we have to figure out is what is the value of the asset going into the GRAT. So if it has a fair market value, and we can ascertain that easily because it's, say, publicly traded stock, we know what to put into the GRAT, we know what it's worth. If it's a closely held business, on the other hand, we're going to need an appraisal of the interest being transferred into the GRAT. Step one. Step two, we want to figure out what the present value of the annuities coming back out of the GRAT to you as the grantor is worth. If the value of the annuity, present value of the annuity over the term coming out equals what's going in, then there's no gift. It's a zeroed out GRAT. Any growth in excess of the so-called 75-20 rate goes to the benefit of the beneficiaries. So what that tells us is that when the 75-20 rate, which is an IRS established rate, changes monthly, is low, and you can generate a return in excess of that rate, then a GRAT is well indicated. A GRAT is advised. We should be looking at a GRAT. Currently, the 75-20 rate has risen recently to 2.2% as of April 2022. And with interest rates rising, we would expect to see the 75-20 rate continue to rise. Does that mean we stop using GRATs? Well, we should stop using GRATs when we can't generate a return on investment that's meaningfully higher than the 75-20 rate. And so this determination of the gift tax value is made at the inception of the GRAT. When you fund it, when you put the assets in it, you've got to determine what the value of the asset going in is and what the value of the annuity stream present value coming out is using the 75-20 rate. And again, there are tools that we use. One of them is Number Cruncher, which is a software program that allows us to calculate the value of the GRAT. If it's a zeroed out GRAT, it tells us that. If there's a gift tax component, we need to report that as being used for some of our lifetime exemption. The steps in forming a GRAT, again, gift the assets, file the gift tax return, make the annuity payments, and pay beneficiaries at the end of the term. The amount of the taxable gift is equal to the value of the property transferred to the trust minus the present value of the annuity interest that's being paid back to you as the grantor, the person creating the trust. So again, we can zero out GRATs. And that means that none of the lifetime gift tax exemption is used at the time the GRAT is funded. So it's a great way to preserve your lifetime gift tax exemption. We know that zeroed out GRATs work because of the case of Walton versus Commissioner, which was tried before the US Tax Court in the 1990s. And it was appealed, I believe, to the Fifth Circuit Court of Appeals. And the government held in favor of the Waltons, which happened to be, I believe, Sam Walton's sister-in-law who was taking advantage of this technique. The IRS ultimately acquiesced, meaning that they ultimately agreed with the Walton decision. So we can now use zeroed out GRATs without fear of being challenged by the IRS. GRATs are permitted under the Internal Revenue Code and regulations under the Internal Revenue Code. There are specific provisions that allow for the use of this technique. So it's less risky than using, say, an intentionally defective grantor trust. The annuity payment has to be measured according to the IRS tables. And another key component of this is if the annuity coming out is not sufficient to, if the cash flow in the GRAT is not sufficient to make the annuity payment, you can make the annuity payment using the assets in the GRAT. So if there's shares that are publicly traded stock and the dividends coming out aren't enough, they can actually transfer stock back to the grantor equal to the value of the required annuity payment, which is determined at the inception of the GRAT. So if the asset is growing higher than the 75/20 rate, we can use the assets in the GRAT to pay down the annuity. At the end of the GRAT term, the remaining assets are transferred either to kids, grandkids, or a trust for their benefit. It could be a dynasty trust, one that lasts in perpetuity or for at least many generations. If we use a dynasty trust, there's no further tax that's imposed on the transfer of the assets to the dynasty trust. But at that time, the grantor will file a gift tax return and elect to have the dynasty trust qualify for generation skipping transfer tax exemption. So at the end of the GRAT is when you can actually elect to treat the dynasty trust as a GST exempt trust, not before then. That's one of the unique aspects of using a GRAT. The dynasty trust can be structured any way you want it to be structured, but usually the goal is to structure it so that income and principal is paid out only in the discretion of an independent trustee. That gives the trust real asset protection for the beneficiaries, and it excludes the trust assets from the beneficiary's estate for estate and generation skipping transfer tax into the future. So as they take distributions from the trust, they don't have to pay transfer tax on those distributions if the trust qualified as an exempt trust from the beginning. You can make it more flexible. The dynasty trust doesn't have to hold back and leave all decisions in the hands of an independent trustee who may not want to make those payments out to the beneficiaries. If you're willing to sacrifice asset protection, but you still want the tax minimization strategy, a family member can be appointed as the trustee. And as long as the family member is limited to making distributions for health, education, maintenance, and support, then the assets are not included in the family member or the beneficiary's estate for estate tax or generation skipping transfer tax. But again, you lose some of the asset protection if you put a family member solely in charge of making distributions out to the beneficiaries. Whenever you're setting up one of these structures, you need to understand the difference between the fact that there is income tax that will always be imposed on these trusts and on the grantor of the trust versus the estate and gift tax consequences. The income tax is a separate taxing system from the transfer tax system, which imposes tax on transfers by the transferor, by the donor, by the person making the gift or making the transfer. And the transfer tax is imposed at a rate of 40% federal and up to 16% in many states, Virginia does not have an estate tax or gift tax. DC and Maryland do. So you've got to be sensitive to the state transfer tax implications of what you're doing. But while you're doing all of this analysis and you're crunching the numbers to determine how much and what to give and when to do it, you've also got to understand that if you set these vehicles up as grantor trusts, which is what a GRAT is, and what an intentionally defective grantor trust is, it's defective for income tax purposes, meaning that the grantor pays the income tax earned by the trust. Let me repeat that. The grantor pays the income tax that's generated on the asset that was moved into the trust. They call it a defective grantor trust because it's defective for income tax purposes, but it's a very effective transfer planning technique. If I'm the grantor and I'm paying the income tax for the benefit of my future heirs, then I'm shifting assets out of my estate by paying the income tax, and they're not having to pay the income tax. The assets grow and accumulate inside the trust, income tax free, and I'm not treated as making a gift, even though I'm paying the income tax for the trust. There's a revenue ruling that's cited for that purpose. So I was telling you, if you have a grantor trust and you're the grantor, you have to pay the income tax on it. And the question is, what is a grantor trust? What makes it a grantor trust? There are certain common powers that a grantor retains in order to cause it to be treated as a grantor trust. Two of the more common ones that you'll see are on the left-hand side of the screen. Reversionary interest is greater than 5% of the assets in the trust, or you have the ability to control the beneficial enjoyment of the trust assets. If you do, it still may be included in your estate, so it may not be effective as an estate planning technique if you have these powers. What other powers can you retain and have it caused to be treated as a grantor trust, but have it excluded from your estate? Well, here are some of the powers, and we use them in our trusts. If you have the power to substitute assets of equal value or equivalent value, and you're the grantor, and you can take out an asset, keep it yourself, but put in a replacement asset that might have a higher income tax basis and therefore yield lower income taxes to you when it's sold. You can do that. It makes the trust treated as a grantor trust. If you have the power to borrow from the trust, even without posing any kind of security interest for the borrowing, you can do that. It's permissible. It causes the trust to be treated as a grantor trust, and you have to pay all the income on the tax that's generated by the trust. If you have certain powers to administer the trust, such as replacing trustees, and your spouse is a beneficiary of the trust, they'll be deemed to have the same powers that you do. Those powers can cause the trust to be treated as a grantor trust. Now, here's something to keep your eye on. I just did a tax alert about 2 weeks ago on the Biden Green Book. Biden Green Book is basically an explanation of all of the revenue proposals that President Biden is proposing to pay for his budget, which includes the Build Back Better plan, a tremendous amount of infrastructure spending that would be required to be paid for somehow. So one of the key provisions is similar to what was in last year's Green Book, and that is taxing unrealized capital gains either at gift or on a sale to a grantor trust, which is what we're talking about, or at death. Those provisions were knocked out of the House bill that was passed by the Ways and Means Committee in November of last year. And they were knocked out mainly because of a very vociferous and successful lobbying effort by the life insurance industry, which has most of its trusts hold insurance policies that are grantor trusts, and it would have penalized future contributions to these types of trusts. So they literally hit every member of Congress with this, and they final House bill knocked out all of the changes in the estate planning area, including taxation of unrealized gains. If I had to prognosticate, if I had to pull out my crystal ball will say that it's very unlikely that we're going to see President Biden's revenue proposals passed, even if it's to pay for something as laudable as infrastructure. The reason is Senator Joe Manchin was the blocker in the Senate who basically stopped any further consideration of any tax bill, let alone a bill that would tax unrealized appreciation on capital gains that are transferred to grantor trusts like the one I'm suggesting. So I think there's still plenty of opportunity to do this advanced planning, not only this year, but it may continue all the way up until 2025 when the exemptions automatically drop at the end of the year. So we talked about grantor retained annuity trusts. A variation on the theme is using an IDGIT, an intentionally defective grantor trust. And again, I've talked about these in the past. You can make a gift to one of these trusts, or you can sell the assets to the trust. If you sell the assets to an IDGIT and you're the grantor, and it's treated as a grantor trust, which is the G in IDGIT, IDGT, then the sale is not recognized for income tax purposes. In that way, it's defective, but it's very effective because I can sell an asset to an IDGIT on a much longer term than I would gift it to a GRAT. GRATs typically are no more than 10 years in length usually, and very often are only 2 or 3 or 4 or 5 years in length. And the reason is the annuity must be paid out over that term, and it includes a principal component. In an IDGIT, if it's properly structured, you can actually have an interest-only balloon loan that's due 15 years down the road, payable with an interest rate pegged to the applicable long-term federal rate, which today is 2.25%. And so that is not such a bad deal, and you can leverage it in a much better way. So the sale is not taxable to the grantor. You can take back a long-term promissory note, which would be included in your estate at your death, but it may not be worth the full face value of the note. And it transfers all the appreciation out of your estate. It usually requires a seed gift, some cash gift or some other asset needs to be contributed to the trust, which equals or exceeds 10% of the obligation coming back in the form of the promissory note. You can also make a gift to an IDGIT, but they're less popular simply because you're using your lifetime exemption, and clients are hesitating using their lifetime exemption unless they have significant assets in excess of the combined exemptions today. Remember, the exemption per person today is $12.06 million lifetime. So a married couple can give away $24.12 million in their lifetime. For now, it's being indexed upward for inflation, so it'll go up again next year. But at the end of 2025, that number drops by half. So a lot of our clients are utilizing their excess exemptions to the extent that they can afford to do so from a financial planning perspective.
All right, Wayne, we do have another poll.
Go for it.
Properly drafted Dynasty Trust can last forever, save estate taxes, provide asset protection, or all of the above.
I think the answer is right on the screen there. I should have had you ask it before we put it up there, but that's okay.
All right, and the results.
So great responses. We're getting more responses. All of the above is a generally correct answer. It could last forever if there's enough assets in it that haven't been used to, satisfy future generations' needs, so to speak. Clearly, it does provide asset protection if it's properly structured, but it definitely will provide estate tax protection as well as generation skipping transfer tax exemption protection. And it can last forever, particularly in certain states that have waived the so-called rule against perpetuities. So it's good to note. And a dynasty trust can be used in connection with a GRAT. It can be used to structure as part of an IDGIT. A dynasty trust can be an IDGIT. It can be a spousal lifetime access trust. It's just referring to the fact that it's designed to last into perpetuity as much as possible, as long as there's enough assets there to support future generations. I have one client who set up his dynasty trust to not benefit his children, to not benefit his grandchildren, and to only provide for health and education for subsequent generations. He already has great grandchildren. So he set up one of these structures, and it's only for health and education, not for maintenance and support. If the generations end up burning out, there are no more heirs to benefit under the terms of the trust, it pays out to charity at the end. So there are ways of structuring these things that can last for many, many generations. The legislation was proposed earlier this year to limit the length of dynasty trusts for 50 years or 2 generations effectively. And the Biden proposal also had a limitation on dynasty trusts to that effect. The advantages, hey, it provides tremendous creditor protection, asset protection, particularly in certain states like South Dakota, Nevada, Delaware, Tennessee, Wyoming, states, Alaska, that have very, very favorable laws that favor these types of trusts as asset protection vehicles. Virginia even has a domestic asset protection trust statute that we've used for some of our clients here. It also allows for multi-generational wealth transfer. So as I was describing earlier on, from the dynasty trusts, distributions can be made. If it's a distribution of income, the beneficiary will pay the income tax on the income, and income generally includes interest, dividends, rents, and royalties. It doesn't always include capital gains. So a beneficiary could pay the tax maybe at their lower rate, depending on who the beneficiary is and what tax rate they're in. But distributions of principal are not taxed if it's exempt from the generation skipping transfer tax as well as the estate tax. And so we try to structure this so that it qualifies for these exemptions. The hardest part of doing these trusts is not only designing how the beneficiaries will enjoy these trusts in the future, but more importantly, who's going to run the trust? I get into this discussion with every client that's setting up a trust every day. And one of the most common questions is, well, can we put a family member in there? Well, the answer is yes. If you have a corporate fiduciary serving with them or an independent third party who's not related to the family, it may generate additional asset protection, and it also may give you a hand in administering the trust, which can be difficult. We've sometimes used trust committees, particularly where there's a closely held business that needs to be administered in the future. So the dynasty trust model, the grantors make a gift or they'll sell an asset to the trust. Maybe we'll use the available lifetime exemption, particularly at its current high levels before it drops by half. And we might also want to use the generation skipping transfer tax exemption. These transfers, if they're exempt from current tax, are transferred tax-free. They've just used up your exemption. In the future, when you give away assets outside of the dynasty trusts, then there would be estate tax or possibly generation skipping transfer tax triggered on those transfers, but not out of the dynasty trust. Again, there's significant advantages of using this technique listed on the box on the left. The kids or grandkids can get discretionary distributions, and the longer we keep this intact, the greater the tax benefit. So we have some dynasty trusts that are actually making distributions to great-grandchildren today. These can last in perpetuity if properly structured and if Congress doesn't change the law. They've tried to change the law for the last 30 years. They haven't done so successfully. What's the advantage of avoiding the GST tax? It's compounding. And this is a static example of not a dynamic example. So if the assets are growing, there's additional benefit. The estate tax rate is the same as the generation skipping transfer tax rate, which is 40%. So as you move down generations, you're shifting more wealth if you took advantage of the generation skipping transfer tax exemption earlier on. And that's essentially what this is showing you. As I've mentioned in other seminars, other webinars, other lunch and learns, the Spousal Lifetime Access Trust has taken on a life of its own, but it's been around for generations. I've been using them my entire career. And it's just, the acronym has really gained prominence in recent years, I guess, because it's kind of funny and cool. A SLAT is a form of irrevocable trust. It can be a dynasty trust, but the benefit of it is that you're setting aside funds or assets in trust for your spouse, as well as future generations that might be able to benefit from it. It provides a source of cash flow now to the spouse beneficiary, and it keeps the assets secure from creditors if it's properly structured. So all the appreciation on the assets that are transferred into the SLAT will be excluded from both spouses' taxable estates at the end of the life of the surviving spouse. And of course, if we've used our excess exemption, the 12 million minus the 6 million excess for each person, we've gotten that out of the estate as well. The key, though, is if we do a SLAT for each other, for one spouse does it for the other spouse, and the other spouse does it for the first spouse, we have to be very, very careful about how we structure it and the timing of structuring this. We want these trusts to be treated as non-reciprocal trusts, which means that the US Supreme Court, which ruled in the Grace versus Commissioner case, reciprocal trusts would be collapsed and brought back into your estate, and it wouldn't provide you any estate planning benefit. Non-reciprocal trusts mean that the trusts are different. So we may transfer assets into the trust. We want to do it at different times if we can. So that makes the trusts different. If we separated them into 2 tax years, do one this year, one next year. If we have different trustees serving other than just the spouse over the trust, a spouse can serve as a trustee, but they have to be limited to making distributions for health, education, maintenance, and support in order for it to be excluded from their estate. But if we have an independent trustee who can make discretionary distributions, then it provides additional asset protection. I'm showing you how these 2 trusts can be non-reciprocal. In SLAT number 1, we're having mandatory distributions of income and principal during the wife's lifetime. On SLAT number 2, an independent trustee is making discretionary distributions that may be delayed after the creation of the trust during the husband's lifetime. We can switch the wife and husband around. It doesn't matter who it's for. It just matters that they're different in the way they operate. So you can see that the distribution of income and principal is different between these 2 trusts. Another difference that we might put into the trust is mandatory distributions during the wife's lifetime, even if the husband is deceased, will continue with discretionary distributions to the children in SLAT number 1, but in SLAT number 2, we might continue this discretionary distribution. Now, we could also give the husband in SLAT number 2 the right to replace the trustee if they're not behaving according to the grantor's preferences. And then lastly, another distinction is making distributions to the kids after both spouses are gone that may be purely discretionary in one trust or limited to health and education, like I was describing for my client in the other situation, or a discretionary distribution subject to an ascertainable standard, like in slat number 2. The ascertainable standard is defined in the code and the regulations as health, education, maintenance, and support. So these are differences that make these trusts arguably non-reciprocal. I mentioned that I was going to talk about using a family LLC with a Dynasty Trust or a slat. And we've done this many, many times. I've done it really successfully for clients who have investments in private equity funds or may actually be the founders of private equity funds or venture capital funds. There's a concept where a partner in one of these funds may get a residual or carried interest at the end of the day. And that carried interest has value. We might want to transfer that out of our estate in the form of a gift or a sale. And in order to do it successfully, we have to make sure that all of our ownership interest in whatever fund we have, whether it's a carried interest, a residual interest, or a capital interest because we made a capital investment in the fund, they're all aggregated and we're taking what's called a vertical slice of that investment and moving it to the trust so that we can utilize our gift tax exemption and we can have it shifted properly under IRS regulations. It's a really complicated concept. The way we accomplish it is we take our entire ownership interest in the private equity fund or the VC fund or the hedge fund, and we drop it into the family LLC, or we'll take a closely held corporate interest and put it into the family LLC. And as the creator of this LLC, you can serve as the manager and manage the investments in the LLC. You cannot make decisions regarding distributions from the LLC. It requires a third party to be involved in those decisions or to liquidate the LLC, to take advantage of the techniques that we're describing. But the step is put some assets into the LLC, set up an LLC, and then perhaps bring your spouse into the LLC. Then, separated properly over time using different terms for slat 1 and slat 2 so that they're non-reciprocal, you might actually transfer a piece of the LLC. You, as the husband, might transfer a piece to a trust for the benefit of the wife, and the wife might transfer a piece of the LLC to a trust for the benefit of the husband. Again, separated in time, different trustees have different provisions in the trust. There's a significant benefit that you can achieve by doing this. If you used a gift structure and you transferred up to 98% of this trust out, let's say we contributed $20 million of assets. Well, the ultimate benefit initially, just the initial transfer tax savings, is about $2.74 million based on the valuation discount that we can get for the LLC interest and based on the appreciation that ultimately will be transferred in the future. So it's a very valuable technique, and you have to get an appraisal not only of the asset going into the LLC, but also the LLC interest being transferred. And it should be done formally with a report that gets attached to the gift tax return. You can also sell the assets. Remember, I was telling you could sell the assets to an IDGIT, which could be a slat. So we could sell a portion of the LLC interest and maybe gift a value to the slat so that it has a seed gift so that the IRS will respect it. And we put in enough assets that meets that 10% test. 5% is 5% of 50% is 10% approximately, a little more than 10%. And we then go out and get a valuation of the assets in the LLC as well as the LLC interest. And we might generate a discount of upwards of 35%. Again, it generates huge transfer tax savings because of the discount and also future appreciation being shifted out of the estate. Here's another illustration of how the slat structure works. More of a 2D illustration. The grantor makes a contribution of an LLC interest or other assets for that matter to the slat. The non-grantor spouse can also be a trustee, has access to the trust assets, and the remainder beneficiaries may have access either during the spouse's lifetime or after both are gone or one is gone. Depends on how you structure it. An irrevocable life insurance trust is just another permutation on the theme. It is an irrevocable trust, usually a grantor trust, which is why the hackles of the life insurance industry got all excited, because they didn't want to blow the tax exemption for these trusts and cause all the inside buildup of these life insurance policies, trillions of dollars, to be subject to tax at death. So they were able to convince Congress to knock all that stuff out of the House Ways and Means bill. Now we're still using irrevocable life insurance trusts. Why? Because we can shelter any assets that are in the irrevocable life insurance trust, including the death benefit that gets paid to the trust on the death of the insured, which happens to be you or you and your spouse, completely from estate and generation skipping transfer tax. It's the gift that we have to be careful about. So each year, if you have to make a gift to the trust, there's certain requirements that have to be met. But the trust purchases the life insurance. The trustee of the trust purchases the life insurance. If you're the grantor, the creator of the trust, you cannot be the trustee. If it's a spousal life insurance trust, the spouse can be the grantor, can be the trustee, but not the grantor. And then on the death of the grantor, the insured, the policy proceeds go into the trust, and they can be used to provide benefits to the heirs or to purchase estate assets or loan money to the estate to provide liquidity to pay the taxes, which we're going to talk about in the last 15 minutes today. How do we pay these taxes that come due? In any event, the irrevocable life insurance trust offers many benefits, and we're still setting them up. And the key is funding it properly. You could either use your lifetime gift tax exemption to fund a purchase of life insurance over time. You could make gifts to the trust, but then you have to satisfy certain requirements known as the crummy withdrawal provisions of the Internal Revenue Code in order to have the contributions treated as present gifts and subject to the annual gift tax exclusion. If you don't do that, then you're using your lifetime exemption to fund the life insurance trust. And then it can be used, these life insurance trusts can be used in a business context. Let's say you've got one child working in the business with you, and you want them to inherit the business. The kids who are not working in the business, you want to make whole. So how do you do that? You buy a life insurance policy and make them the beneficiaries of the insurance trust so that there's some equalization in the estate. So that the kid getting the business got the business, the kids who participate in the life insurance trust may get life insurance proceeds or the benefit of the life insurance proceeds. Lastly, I wanted to briefly mention corporate recapitalizations and partnership recapitalizations. These are a separate topic unto themselves. And the reason is that it's an extremely complicated area of the tax law. It involves extensive valuation work done by an outside appraiser. It always should. And there are income tax and estate tax consequences of restructuring the entity in order to take advantage of shifting wealth to future generations by recapitalizing the company. What am I talking about? I'm talking about changing the corporate structure. Let's say you own 100% of the stock of your closely held business, and you have for 50 years. Now you're thinking about, how do I get this to the next generation at the lowest tax cost possible? You might create 2 or more classes of stock or membership interests in a partnership or LLC structure. If it's a C corporation, not an S corp, you can use preferred stock. You cannot create preferred stock in an S corp. You can use voting and non-voting stock in an S corp, which might generate some level of discounting. But preferred stock generates a freeze on the value of the stock that you might hold back as preferred stock and pay yourself a coupon, a dividend every year that gives you income from the company. All the future appreciation might be transferred in the form of the common stock that's transferred to future generations or trusts for their benefit. The tax considerations are really important. Again, with S corps, you can't use preferred stock, and you want to minimize any kind of gain recognition on the transfer of the shares. If you transfer the shares of the company into a trust that's a grantor trust, you don't have to pay income tax on the transfer, even if it's sold, but you may have to use your lifetime exemption. You also want to minimize the impact of any kind of gain recognition if the trust you're transferring it to is not a grantor trust, a non-grantor trust. And so whatever you put into the trust, you have to get back something of equal value. It could be a promissory note, but that's when you get into questions of whether the note really is worth the value of what you put into the trust. And there's a code section that I cite at the bottom of this page. It's very complicated, but it basically says, if I transfer an interest into one of these trusts, and I have a retained interest in the form of an annuity or something along those lines, the gift that I'm making is worth 100% of the property that I'm transferring, even though I may be retaining an interest. And that may not accomplish your objectives. An exception to that rule is a GRAT. They allow you to transfer assets either with some gift tax value or no gift tax value using a GRAT. And this vertical slice that I was telling you about is another way of getting around this draconian 2702 rule that prevents you from using your lifetime exemption and causes basically potential gift tax consequences on the transfer. So you have to be very careful about that. S corporations are quirky. We're going to go right to that. Ignore the thing that keeps repeating on the right. I didn't know how to turn it off. You have 2 years if you acquire S Corp stock to make it transfer it to an eligible shareholder. So if the stock is held by an estate or an irrevocable trust that does not qualify as an eligible S Corp shareholder, you've got 2 years to change that status. In the trusts that we draft, we include provisions that allow the trust portion that owns the S Corp stock to convert into what's called a qualified subchapter S small business trust or an electing small business trust, if you want that. But those have their detriments as well as their benefits. And the executor should be given the authority to enter into agreements with the other shareholders regarding making these elections and whether or not it's in the best interest of the beneficiaries as well as the decedent who set up this whole structure to begin with. The key is in partnerships, LLCs, S Corps, valuation discounts are important. And in a partnership structure, valuation discounts may be enhanced. You have to be really careful about a situation where you make a gift of a partnership or LLC interest where capital is not a material income producing factor. In other words, that may cause the transferor to have to continue paying income tax. If capital is a material income producing factor, meaning that you've invested capital and you've bought real estate or you've got stock or other types of investments that are in the LLC and partnership, then you can shift the income tax consequences to the trust or the beneficiaries of the trust under certain circumstances. So be aware of this rule and know what you're putting into the partnership. It's just an issue spotting exercise for the advisors out there. And that's under the family partnership rules. So I'm going to skip past these. We're going to go into the last few minutes. We're going to talk about Section 303, Section 6166 of the code. 303 gives a pass to an estate that holds regular C Corp stock. And if there's earnings and profits, instead of the distributions from the C Corp to be treated as dividends, or a redemption being treated as a dividend, which causes the entire payment to be taxable, Section 303 allows for the basis of the stock to be stepped up to fair market value and the redemption to be treated as a capital gain, which means that if the basis of the stock equals the fair market value because it's been stepped up at death, these 303 redemptions won't trigger any income tax consequences, even though it otherwise would. And it requires that there be a distribution of property directly to a shareholder of the corporation, which may be the estate. It's got to be in redemption of a piece or all of the stock in order to get that favorable treatment. And if those conditions are satisfied, then we get to use the proceeds to pay for the estate tax if we need to. So it allows us to effectively take a liquidating distribution out of a C Corp to pay the estate tax without being penalized on the income tax side. These two code sections allow us to defer payment of income tax. I'm going to focus on 6166 mostly because it's a really valuable and not as well-known provision of the tax code. You can defer the payment of estate taxes for as long as 15 years after the date of death using code section 6166. The key is that the closely held business must be at least 35% of the adjusted gross estate. So the value of the business has to be significant in comparison to the overall estate. So that's number one. Number two, if you own a bunch of small, closely held businesses, but you own at least 20% of those business interests, you can actually aggregate them together to meet the 35% test. So if you have 21% in one business with a partner or partners, and you own 80% in another business, and you own 75% of another business, you can aggregate those interests for purposes of satisfying the 35% test. And then we figure out what the values are and whether or not to elect to defer the tax. How does it work? We can elect to defer the tax and have it paid from anywhere from 2 to 10 years after the 5th anniversary of the due date of the tax return. That's where I get the 15 years. So for the first 5 years, we may only be required to pay interest. And the interest rate starts at 2%, but for anything over $1 million indexed for inflation and value that's included in the estate, it's 45% of the underpayment rate, which is actually less than the 2% rate today. The 45% of the underpayment rate is 1.8% today. So you can finance the payment of the estate tax on an interest-only basis for the first 5 years if you qualify. It's not easy to qualify. I've filed these elections for estates in the past, and the IRS, in their discretion, can grant it or not. I'll give you an example of where we used it very successfully in an estate back in the 2000s, 2008. Client passed away. She was an owner of many different rental properties in and around the Washington, D.C. metro area, and she was effectively still managing the properties. She was doing the books on the properties. She'd send her son out to do the site visits because she was getting older, but she was still making all management decisions on the properties. That qualified as a closely held business because the real estate was active. She was active in the trader business. And that, believe it or not, was considered an active trader business that qualified for the 6166 relief. And so we filed an election, not only to delay the payment of the estate tax for as long as we possibly could, because it would have imposed an undue hardship on the taxpayer to have to liquidate all these properties. And if the buyer knew that it was an estate trying to liquidate the properties and were under a time crunch to do so, then that would be a problem, right? It would create a liquidity crunch. The estate tax normally is due 9 months after the date of death. 9 months after the date of death, which is when the estate tax return is due. You can extend the estate tax return by 6 months or even longer with IRS approval. You can extend the payment of the estate tax with IRS approval for reasonable cause or in the event of undue hardship. So often taxpayers will file an election under this code section 6161 to get an extension of the payment of the tax, but also to qualify under 6166. You lose the deferral if you sell off the business interest. And you're thinking to myself, wait a second, I just heard you say under this code section 303 that I can redeem the business interest, take the cash, pay the estate tax. You can actually couple the 303 redemption provisions with this 6166 election and spread out the redemption payments over 15 years, making sure that the taxes get paid without blowing the ability to defer it at this low interest rate. A lot of our clients do that. Okay, so that's kind of cool, and it's something to think about. And you want to make sure that you structure the estate tax, if you can, to defer it as long as possible legally. And that's what 6166 is allowing you to do. There's also a concept where you can deduct certain types of expenses from the estate currently. There's a concept known as a Gragen loan, Graegin. The Gragen loan was enacted through a tax court case that was it was basically held in the late 1980s. And that court case basically said that the estate can go out and borrow from another entity that's affiliated with the estate, maybe a corporation that has cash available, and deduct the interest payment, the present value of the interest payments, even if it's over a period of time. We can deduct it as an administrative expense on the estate tax return. It has to meet certain requirements. And one of those requirements, it has to be a business where there may be an unrelated shareholder who is part of the business, maybe a 1% interest. But the idea is the estates lack liquidity to pay these taxes. Where are they going to get the money from? If there's another business out there that can finance the loan and get a deduction on the estate tax return to reduce the estate tax, that's the best of both worlds. So that's the Gragen loan scenario. Do we have any other poll questions, first of all?
We do. We have one last one. We would appreciate it if you guys did this. On what topics would you like us to focus on in the future? More estate planning, income tax planning, business planning, fiduciary services, or business succession planning?
And obviously within those topics, there are myriad topics. So if you have something that you would like us to focus on, send us an email. You can send Kat an email to Kat, C-A-T-T @zellaw.com, or me, Wayne @zellaw.com. Or if you have an idea right now, pop it into the chat and Kat will jot it down before we sign off. But tell us, where your focus really is. We've got a lot of clients that are asking us to talk more about the income tax stuff. We've got other clients that are saying, hey, look, I'm getting ready to get my business for sale. and I'd like to figure out how to do that better. There you go. 60% of the respondents indicated more on the business planning side. So we're going to talk about that. Actually, our lunch and learns that are set up for the rest of the year are all business planning topics. So that'll be good. So if you sign up, get your friends to sign up, get your clients to sign up. We'd love to have everybody participate in these seminars. They're free. And if you're a CFP, you can get CFP credit. I think we're nearing the end of today's session. I greatly appreciate all of you who participated today. If you didn't, and you know of somebody who wanted to participate, but they couldn't, they got called away, we'll make sure that a link to the presentation is available to them. And we'll make these materials available to you as well. So just let us know. We'll get them out to you and send them to you so that you can refresh your memory about what we talked about. And I know I covered some items really quickly. Apologize for that, but we'll try to dig into some of these topics in the future if you decide that that's something that you really want to talk about, like 61, 66, or Reagan loans. Very interesting stuff, but it only comes up in the event of death. And so most people don't want to talk about it until it's absolutely necessary. So thank you for listening today. Next topic, next time will be on Kat, I think it's
which formation type should my family-owned business use to protect their assets? And it's on May 18th.
Beautiful.
And if you go to our website, I went ahead and put the webinars link into the chat box. You're able to register to any of those upcoming courses right away.
Beautiful. And again, thank you all for participating. Have a great week. We'll talk to you soon.